Asset allocation and diversification. An example of asset allocation and diversification using Markowitz theory would be a portfolio that includes a mix of stocks from different sectors like technology, healthcare, and consumer staples, alongside bonds with varying maturities, effectively spreading investments across different asset classes to reduce overall risk while aiming to optimize potential returns based on an individual's risk tolerance. This approach leverages the concept of negative correlation, where assets tend to move in opposite directions, mitigating overall volatility. Some key points about the example: diversification across asset classes. Instead of investing solely in high-growth tech stocks, a diversified portfolio might include a mix of large-cap stocks, small-cap stocks, government bonds, corporate bonds, and real estate investment trusts to balance risk and potential return. Considering correlation, the Markowitz model emphasizes analyzing how different assets move in relation to each other. Correlation. For example, when the stock market is down, gold prices might rise, creating a potential hedge against market fluctuations. The efficient frontier. By plotting different portfolio combinations on a graph with risk on one axis and expected return on the other, an investor can identify the efficient frontier, the set of portfolios with the highest potential return for a given level of risk. Specific examples of asset allocation using Markowitz principles: a young investors with a high risk tolerance, a portfolio with large allocation to small cap stocks, emerging market equities, and high yield bonds. A conservative investor nearing retirement, a portfolio with a larger allocation to government bonds, dividend paying stocks, and cash equivalents. A balanced portfolio, a mix of 60% equity and 40% fixed income to achieve a moderate risk profile. Balanced funds, a common type of asset allocation fund that balances equities and fixed income, such as the 60% stock, 40% bond equation. Dynamic asset allocation. This strategy frequently adjusts the mix of asset classes to suit market conditions. Some other things to consider about asset allocation and diversification. Risk tolerance. Investors with different risk tolerances may choose different asset allocations. For example, someone saving for a new car in the next year might invest in a conservative mix of cash, certificates of deposit, and short-term bonds. Goals. Your goals should be considered when determining the right asset allocation. For example, if you're saving for a retirement condo in 20 years, you don't need to worry about short-term fluctuations in the stock market. And correlation. Investors should avoid choosing investments that are highly correlated. When some assets go in one direction, other assets with a negative correlation go in the other direction. Jensen and Jones posit a diversified portfolio consists of two elements: diversifying across asset categories and diversifying within asset categories.